All right, starting to record. So for the recording really quickly, I was just talking about the importance of having passive income set up, and that's what this stream focuses on. We're talking about portfolio structuring right now, and we've identified these 4 different buckets, but I haven't told the people what they are yet. June, you have an unfair advantage here. So, but you're free to speed things up if you want. I'm going to add 1 more letter to each. Streams of income? Technically, yeah. All right. What we talked about yesterday? Absolute. Are you both driving? You guys are fighting over the steering wheel? I love it. You have like a motorcycle sidecar situation? All right, I'm just gonna fill these out here real quick because I don't want anyone to be not focused on the road. Okay, so we have investments in one bucket. We have passive options in another bucket. We've got speculation in another bucket, and we've got cash in the final bucket. Does that make sense to everybody? This is the topmost set of structure rules that you can put in place within a portfolio. Obviously, there's rules for outside the portfolio as well, like making sure you're building and maintaining good credit to avoid the poor tax, basically, and to expose yourself to lines of credit so you can live tax-free on debt. And then there's financial security and stability with budgeting and making sure that your inflow and outflow have a good cadence. And then in the portfolio, we have investments, passive options, speculation, and cash. Okay? So who can tell me the difference between investments and speculation? I'll take any answer here. You guys can hop on mic too if it's easier. If you're on the Rags to Riches team, you guys can just pop open your microphone and start screaming at me. I won't take it personal. Oh, Elizabeth's typing. I will keep pushing forward too. I don't want to like just drag out time here. I just want to make sure you guys have the opportunity to participate. Investment long holds, speculation is short. Yeah. But there's a deeper difference there that we can talk about. There's 2 different ones. I'll just go ahead and elaborate. So investments are, you're trying to literally predict the future growth of a company based on its growth trajectory or its potential with broad application. You don't have future information that you can use, and you plan to hold these for a very, very long time because you believe in the growth of the company. Now, you can also believe in the yield of an investment if it's like a dividend income ETF, for example, like O is a good one for that. Speculation, you don't care about that at all. You don't care about the company. You don't care in most cases about what they do or how they're going to do it. You only care about the potential with each opportunity within the chart based on the volume that comes in and either fulfills that potential or overpowers it. Okay, so in the speculative sense, you're trying to copy the past. You're trying to relive the past. Investments, you're trying to predict the future. Okay? In the sweet spot between them, you've got passive options. Passive options are a really good way to just make money by selling contracts to people that are trying to speculate and taking advantage of the theta decay and the IV fall off on those contracts when certain conditions present themselves. It's also a really good way to put in some mechanical strategies. Now, there are some pros and cons to each of these, right? Let's first consider taxes. For investments, if you're not selling anything, you only have to care about the dividend yield. For taxes. That's your only taxable event in this case. Does that make sense to everybody? Because if you're not selling these, you're just amassing a huge portfolio full of assets so that you can then take that to a specialized lender, open a line of credit, an S block, and then live tax-free on the debt with a very low APR. You're not going to sell any of that stuff. You want that account to get as big and fat as possible so that you can get as much line of credit as possible so you can live comfortably without exceeding a 10 or 15% loan-to-value ratio. Does anybody have any questions about that before I go too far? Because that was a lot of words. You love passive options more than you love Breckles only feed account. That's how I know you're a liar. That man's got gold. Oh, no, you're good. You're good, Elizabeth. I know you guys are driving. Oh, you just dropped the dirt bike off. The kid's dirt bike? Or did you guys get one for yourselves? That's good stuff. All right. So what I'm hinting at here is that you really don't want to sell your investments unless there's some insane pop in price and you don't see it maintaining, and you've been holding it maybe for a couple of years, or you plan to hold it for a couple of years. You've really taken into consideration the future, the terminal value of the company, and there's different ways we can do that. We can use the DCF modeling, the discounted cash flow, which incorporates the Gordon growth model for projected dividend growth. We can use all kinds of stuff. I'm not going to get into all the nitty gritty there because then I'd have to explain it all. So I'm really trying not to make this too. I don't want you guys to think a bunch. I just want you to understand that there's buckets that things fall into, and then in each of these buckets there's other buckets, and they all have a role. No, you're good, Snowflake. I hope work's picking up for you. I know it's been pretty rocky over the past quarter, so hopefully things are okay now, or hopefully better. The passive options side, you've got a lot of churn. You've got a lot of turnover in your portfolio. So this is mostly going to be short-term capital gains, STCG, short-term capital gains. Now, dividend yields can be qualified or ordinary, but ideally you're just getting qualified because you should just be picking high-quality stuff. And these are two different tax rates, plus, minus, tax rate. Okay. Short-term capital gains pretty much always going to be the same tax rate, flat tax rate, FTR. Okay. So short-term capital gains, because you're just constantly collecting income on these, you're just constantly either being assigned with the wheel and then selling, or you're selling the contracts separately for a different strategy, or you're offsetting the cost, or maybe you're dripping stuff, or however you're approaching that middle ground where you're collecting consistent yield, you're going to almost exclusively have short-term capital gains. Now, you can have a longer-term hold that you're collecting small amounts of dividend on, but the bulk of your money in this bucket is going to come from selling the yields on the contracts, the premiums. So that's almost exclusively going to be short-term capital gains, which means you need to offset that with losses elsewhere. And you need to offset that with profits from elsewhere so that you can make enough to be comfortable paying taxes. And that's where the speculation comes in. Speculation is never going to be long-term holds. You're always going to have short-term capital gains, right? Because if you're speculating and you're holding something for 3 years, you're not speculating. You're hoping because you're a bag holder, right? Now, in this case, you've got tax loss harvesting as well. And then you've got the tax implication pretty clearly mapped out. Now, you've got one other thing to consider in this portfolio, and that's your cash. If you've got a broker that's offering you maybe 3.5% APR, that's pretty solid. It's equivalent to a high-yield savings account. You're liquid in the fact that you can buy shares, but it's sitting in an account. It's not in a high-yield savings account. So you've got a little bit less stability in case the broker decides to change their rate, which banks can do too. So it really just depends on whether or not you need that money in a bank account or in a brokerage account. I personally prefer to keep some in a cash account or in a broker account, just so that I can have access to the market in case there's a really good opportunity. But for the most part, I always want to keep some portion cash. I'm not going to do that. So that's kind of the thing that we want to get into here, because this is also interest, right? Interest has its own special tax obligation for it. You're going to get a 1099 INT off of this. I can't write today. 1099 INT, just like you would from a bank. Does that make sense? So we're mapping out the tax burden and tax advantages for each of these. Now, on the investment side, you've got almost no obligation, and you've got almost no tax advantage, right? You don't have a lot of tax action on the investment side because it's just buy and hold for the most part. And then you're just looking to offset the dividends, which should be at a reduced rate if they're qualified because you've been holding them for 6 months or more, they're a domestic company, and blah, 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 all the other criteria met. So there should be a very small amount of money when you're getting started, which will eventually snowball into a very large amount of money, which is where you're going to have to lean into these two a little bit more aggressively than you may normally do if you already had that amount of money and you were new to the market, which is why we have to practice. We have to build up. On the passive option side, you're going to have exclusively short-term capital gains, occasionally you have losses. Like that doesn't go away. Like you're going to get underwater on some wheel stuff, and you have to find a way to get out of stuff. You're going to have spreads that you're just going to have, you might have to take a hit on it if you're doing the, let's say the ratio spreads, and you allow it to go beyond the point of max profit, and it starts to decay. You might take a loss on that as well. Say a move happens overnight or something that you just can't predict. Losses are all part of the game, no matter what. You're going to have drawdown on these investments as well. But the idea here is that you want these to go up. You want these to go up in terms of yield, and you want this to kind of do one of these situations, or more specifically, you kind of want it to do one of these over time, because the position size will scale up naturally as you maintain this ratio, which means the amount of cash you also have on hand should scale up over time, but at a much slower rate. Does this make sense so far? We're talking about the first layer of portfolio structure. We've got investments, we've got passive options, we've got speculation, we've got cash. Now, you don't need to do all four of those, but at the very least, I would recommend, to the extent of my ability to recommend, you are going to want investments. Let me just change this to an actual arrow so it looks a little bit cleaner. You're going to want investments, and you're going to want either passive options or cash. You don't have to do speculation if you're not comfortable with it. The main advantage here is that it provides you with tax advantages, and flexibility. So if you're already taking losses elsewhere, you can slow down on this because you're not going to need it. And if you're reinvesting your profits here, you just won't have cash to pay the taxes on the profits you've made from the passive options or the investment side on those smaller amounts of dividends. So that'll be the challenge that you have to solve. And then at the end of the year, it's a very easy formula. You just sell for a loss some portion of what you've made in profits because you already have the shares. They're already reinvested. So you don't have to deposit more money just to make your losses happen. And you're not really break even, because if we break it down logically, if I turn dollars into shares, right? This is me buying something, and then the price goes up, and then I sell that share back into dollars, and then as I'm holding it, I get more dollars, and then I turn those into shares, okay? And then I take this set of dollars, and I turn it back into, sorry, I drew that wrong, my bad. And then I continue to hold, or if I turn this back into shares, and then I turn that into a loss, right? As far as this initial amount goes, I have the same amount. I have dollars, right? The same amount of dollars. But I also have the share that I acquired by reinvesting that. So this is the surplus. This is where the advantages come in, because this is brand new. I pulled this out of the market for free, but I have no tax burden on it because I've got my initial amount back, right? Just like we talked about, I think 2 weeks ago. And we talked about it in Lifetime, I believe, or on one of the premium streams. This strategy here is what allows us to pull shares out of the market for free and into our portfolio. That's the goal. Yeah, remember, our number one goal is to amass a giant portfolio full of shares that have an increasing net value. And then the way that we do that is we balance the conversion, the transformation between cash and shares in every other area in an efficient way so that we don't have a tax burden at the end of the year. That's the ideal scenario. It's not going to be the most efficient because people want to make more money so they have more resources to work with, which is going to lead to, profit or loss. But you'll be off baseline. But if you want to do this completely Zen-like, this is the way to do it, in my opinion, because you want those free shares without tax burden, and you don't want your cash amount to be disrupted either. So if you can start the year with, let's say, $5,000, and you can end the year with $5,000 plus a couple of free shares and no tax burden, I would absolutely do that in a heartbeat. Does that make sense to everybody? So if you're worried about breaking even by tax loss harvesting and selling back to your baseline, that just means that you don't have any other value added into the equation, which means you didn't reinvest anything. Okay, so let's, I'll copy this and I'll share it here so you guys all have a copy, but I want to walk through that process specifically because I feel like that's probably one of the most important concepts that I can explain to you guys. So if I take $1 or some number of dollars, right? Let's say I do 3 of these. Okay, so 3 positions with money, right? That's what we're here for. Money. Okay, and then if I can take that money and turn it into shares. Let's say I use the dividends, right, to buy this 1 share. Through all 3 of these, they all provide a dividend, right? I'll use a small circle here to represent a dividend. And then I should probably shrink this box down because it's not going to be huge. Okay, that's the share that I'm buying. Okay, if I pour the dividends from those 3 positions into 1 stock that I want to reinvest in, okay, this means I've got a taxable event here, I've got a taxable event here, and I've got a taxable event here. And I know I'm crossing the lines over here a lot. Taxable event, and this is a free share. Okay, so now I've got to figure out, like, I've got the share, and that's great, but what do I do about the taxable event? Because just because I've reinvested it doesn't mean I don't still have a tax burden on it, because all I've done is turned it from cash into a share format. So it's still mine and it still has value. It's still a capital gain as far as the IRS is concerned. Now I have to offset the tax burden on that. And to do that, I simply sell for a loss on another position or some other, maybe 2 positions. And that takes these dollars, right, these 3 initial sets of dollars, and it converts them into a big fat 0 in terms of net. But I've got these free shares hanging out now. Does that make sense? Dugo says, I want to start... you want to start the year with $5,000 and end with $8,500 and free shares. And you can do that. You just have to understand that if you have a surplus, meaning a net cash profit, you're going to have to pay taxes on that. If you have a net share profit, you're also going to have to pay taxes on that, because the only way that you could have gotten there was to either deposit more money and buy shares, which doesn't count as a net profit in that case, or you've made a profit and reinvested it. So it's the making a profit part that messes people up. So we can offset those profits to an extent. Let's say your total value, right? Let's say you started the year with 5,000, right? And let's say you brought that up to 10,000 total, right? Let's say 3,500 of that is cash. That's not a 0, right? And then 1,500 is the form of free shares. Now, personally, I feel like that'd be backwards. You'd probably want most of that to be reinvested and little of it to be in cash. But in order to get from 5,000 down to 10,000, you've got a $5,000 profit that you need to mitigate. Okay, and since this is within a year, right, because you said you want to start the year and end within a year, you then need to offset this $5,000 somehow or pay the difference in tax. And that's okay. You can absolutely just accept that you have to pay taxes and look to offset it elsewhere through maybe business deductions or earned income credits or some other number that you can shuffle around on your tax form. But if you're trying to do it just with a portfolio, you're starting with 5,000, you're ending with 10,000. You have a $5,000 tax burden because you've got short-term capital gains, and you know that in order to reduce that, you're going to have to offset it with losses, or maybe you have carry forward losses from the prior year. You can use that as well. But the fact is, you now have $1,500 worth of new shares, which is great. You know, it's a good percentage there. And you've also got $3,500 to potentially pay taxes on. But you're not paying taxes on the $3,500. You're paying taxes on the $5,000. So figure about 35-40% of that, and you've got maybe a $3,000 tax bill, maybe a little more, or no, that'd be 60%. What am I smoking? $2,000. That's about 40%. Does that make sense? And again, that's okay, right? Worst case scenario, if you have to, you can sell these reinvested shares, throw in another 500, and you've got all your taxes are flat again. But you can usually find that $2,000 elsewhere in your taxes. But if you didn't want to deal with this at all you have to do is take those $1,500 that you've invested, set them aside, and then deal with this $3,500 to reduce this number as much as possible, so that you maybe only pay 40% on $1,500. Let's say you sell the entire $3,500 back. If you can't work this out tax-wise, and you can do your taxes ahead of time, you can prepare them ahead of time and figure out how much you need to sell. if you want to. But let's say, for example, you don't want to pay taxes. You can't find those discounts elsewhere in your tax portfolio or your tax profile. You have $5,000 to pay taxes on. So if you got $3,500 in cash, you can at least pay that portion down, and then you're only paying taxes on $1,500, which are your quote-unquote free shares at this point. I don't know why I draw these all out of order, but I'd rather pay 40% or 35% on $1,500 instead of $5,000, and then you're just finding a way to offset the $1,500 tax burden, which is a lot easier to do in most cases. Does that all make sense? Because you've given back $3,500 of the $5,000. And I'm not saying that applies to you specifically, because you're specifically looking for a cash and share profit at the end of the year. If you just wanted the shares for free with no tax burden, you'd give back that cash. If you want cash at the end of the year, you're going to pay taxes, and you just got to offset it somewhere else, and that's okay. But when you get up into the 7-8 figures, you're going to have to be a lot more deliberate about your taxes. There's a lot less forgiveness because finding deductions becomes a lot harder when the number from all the income gets a lot bigger. And that's why, that's why you really just want to not deal with tax at all at that point, and you want to really just build a portfolio of assets like we talked about, and then use securities-backed line of credit so that you live on tax-free debt instead of paying taxes on, 7-figure income or 6-figure income. It's not fun. That's why wealthy people do the things they do, because it just makes more sense. I don't want to pay 35% on 6 figures to the government because I'm not getting anything extra for that. I am instead more happy to pay a 3% APR on something that I have the ability to control how much I use, and it's still a nice low LTV where maybe it's 10 or 15% of the total line of credit. And then if worst case scenario, let's walk through the math, right? Let's say you've got 10 million, right? And this is way up there, right? This isn't tomorrow. It's not next year. It's not next decade, maybe. But let's say you're there. You take out an S block. Let's say you take it out for 2 million, right? 2 million at 3%, right? Those are pretty ideal conditions, I would say. Now your 10% LTV, which is typically, you want to keep it between 10 to 15%, because you don't want to rock the boat, right? 10 to 15% LTV, that equals about 200K of credit that you can draw if you want to keep it under that ratio. Okay, and 3% of that, let's pull that up here. 200 times 0.03, it's going to be 6,000, right? 6K. That's your annual interest if you if you drew on the full 200,000. What's up, Affliction? You got a hot mic. Thank you, sir. Just so nothing personal gets on the stream. All right. Does this make sense so far? Does everyone know what an S block is? A securities-backed line of credit. And I know a lot of you aren't there, so your eyes will gloss over and you'll tune out. But this is the time to pay attention, because this is what you want to. This is your end goal, right? Okay, so we got a note in the chat. So a securities-backed line of credit is basically just a special loan that's a lot like a HELOC, but instead of using your home equity, you're using a securities portfolio. So let's say you've got $10 million worth of shares, right? You take it to a specialized lender like Morgan Stanley. I keep using that one as an example. And then they offer you a line of credit knowing that it's backed by your securities that you've offered as collateral. So a lot of people would hear this and be like, oh, there's no way in hell I'm going to risk $10 million on a loan, right? Because loan automatically is a bad word for most people. But in this case, you're not going to lose all $10 million. If you default on it for some reason, let's say you get in a horrific accident and you're laid up in a hospital bed for 10 months and you somehow pull through, you're not going to lose all 10 million. When you take the securities-backed line of credit out, you have some rules to follow, and so do they. You're only authorizing them to liquidate what's necessary to repay the amount that you've borrowed. So if you borrow 200K, you draw that credit up to 200K to keep it below that 10% LTV. You pay your interest of 6K per year on that. You can reinvest most of that, live on a smaller portion of it, and have a pretty good time most years, right? But again, if something horrific happens, then you've authorized them to go in and sell only what they need to cover the loan, the line of credit, so that they can be squared up. That's all it is. You don't lose all 10 million. They can liquidate up to 200K basically, and then whatever fees they decide to apply. So they're not scary. I know it might seem scary at first, but basically you're just taking out a line of credit. You're borrowing against your portfolio of assets. Now, the reason we want to do it this way is because of this main advantage that debt carries, right? And I know, again, debt is a bad word for a lot of people, but it's really not that bad, and it becomes your best friend once you get up to a certain level, because all debt is tax-free. That doesn't mean that it doesn't cost you things, because obviously there's unhealthy debt, but debt is tax-free by default. So if you take out a HELOC, that is tax-free. If you take out an S-block, that is tax-free. Payday loans, those are tax-free. If you get charged tax on that, go talk to someone right now and get that person in trouble. The government specifically cannot tax debt. So why not turn that into a powerful tool and use it to leverage your wealth instead of paying 35% in income tax? So let's say we take that same 200K, right? 200K, and let's say we day trade it, or we trade futures, or we trade something that's very liquid and high turnover. Let's say we take that 200K, or we made 200K out of our $10 million whatever, right? Now let's pay 35% tax on that. You're looking at 70K. So the IRS gets 70K of your 200K profit. I'm not happy with that. I don't like that at all. I could pay less than 10% of that with an S-block, and without having to do all that work. Apologize. I'm down, man. I don't think they've been needed since the 70s, honestly. I think that is such a waste of resources and fear. Like, they put a lot of people in fear for no reason. But that's a whole separate topic. I don't want to get into my views on that. I just know that when I pay taxes, I don't get more for it. And just like I wouldn't pay more for a cell phone if I'm not getting more features or more service, why the hell would I pay the government more if I'm not getting more representation, right? So this is my personal view, but my goal here is to help everybody here understand that discounts are abundant in this life, and we can, without living like frugal hermits, we can reduce unnecessary expenses and increase the gap between our inflow and outflow. And that gap is called wealth, and it compounds very nicely once you figure it out. So I didn't want to go too far down the rabbit hole on S-blocks, but I wanted to make sure everybody here understands that that's the end goal for most savvy investors here. Sorry about the high contrast here. I was expecting that to be a darker background. But that's the goal. That's why we pour everything we have into this big investment bucket over time. Now, the way that we get there, let me pull up my Discord again so I can see what you guys are writing. The way that we get there, okay, I got plenty of time. The way that we get there is going to be through a series of deliberate moves and a solid understanding of the market, right? This portion applies to your passive income. It applies to your speculation. Hell, it even applies to your settled cash. Okay? And you guys probably already know where I'm going with this. This is where we start with speculation. Let's say we make $300 and we want to get it to $400. And then 400 up to 600. I'm just putting some numbers on here. Let's do 800. Let's do 1200. Pretty big jump there, but that's okay. 1500, slightly smaller jump. 2000, back up into the bigger jump section. And by big jump, small jump, I'm just talking about the number difference between them. And then 2500 is a relatively similar jump there. All right. So you guys already know where I'm going with this. Let me just draw the lines and we'll make this relatively painless. So if I do this 3 times, and then I go down and I do this 3 times, and then I do this 3 times. I'll explain this here in a second. 3 just being an arbitrary number that I've chosen because I feel like that's where most people would tend to get hemmed up a little bit. Okay, so the idea here is that we've got some small amount that we can choose for speculation. I don't care if it's $10. You guys see, look, literally, I'll show you guys. I'm not saying, like, I'm not trying to show off, but I'm saying it's definitely possible. This account started at $25, I think, at the start of the week. I just keep trimming it back down. It doesn't really take a lot to compound these profits, but you also don't have to take big risks if you don't want to. You can compound 1% over and over and over again. But I'm just showing you guys it's possible. Okay, and regardless of how you get there, whether it's passive options, whatever. I personally encourage people to use less, so that way the hits aren't big. And if you want to, let's say you want to start with $2,000, you can start with 25 and build that 25 up to 2,000. It's just a function of time. You don't have to just start off with $2,000, especially if you can't grow a small amount up to 2,000. Starting at 2,000 is just extra risk. So it's my personal stance on it. You guys are free to do whatever you want. But if I start with $300 and I build that 300 up to 400 and then I trim it back down to 300, that's $100 I can put in the pot. I'll just draw these over here. And then I do it again. I bring 300 up to 400 and then I trim it. That's another $100 in the bag, right? So I've made $200 profit on this $300 seed amount. And then I do it again and then I trim it again. That's another $100. Then I go from 300 up to 600 because I'm comfortable enough approaching $400. I can let it grow a little bit more. Whatever the numbers are is up to you guys. Could be 500, could be 450. Who knows? But from 400 up to 600, then I trim it. That's $200 in the bag. And then I do that 3 times. Okay. And then I'm comfortable enough approaching 600. I let it go up another 200. And then I trim that. That's another 200. 3 times. All right. And then I go from 8 to 1,200. And then I trim for 400 3 times. That's $1,200 right there. Across all 3 iterations of that. Then from 12 to 15. And all this time, the investment side is growing. The passive option side is growing, unless you're using this same approach for the passive options. But it cascades upward very nicely. Okay. So from 12 to 1,500, you do that 3 times. That's 900 extra. From 15 to 200, that's another 1,500 because you're doing it 3 times. Right? And it might take time, and that's okay. The point is that you're letting the numbers and the process drive. And then 1,500 here for the third one. So all these are going into this big pool, which is just the next level up. So in this case, if it was speculation, that money would go into passive options. If that money then was in passive options and growing and hit your ceiling, it would then get trimmed and go to the investment side, because that's the final bucket, the final destination, if you will. So in this case, let's do some math here. We've got 300 plus 600 plus 600 plus 2,100 plus 3,000. So we would have turned $300 into $6,600 worth of profits, plus the original 300 would be $6,900 that we didn't have before. Now, I'm not saying that is easy. I'm not saying it's guaranteed, but that is the process once we demonstrate net profitability, where we can bring 300 up to $400. That's a 33% net profit. We can do that 3 times. Okay. From 400 to 600, that is a 50% profit. We can do that 3 times. And I'm not saying 350% trades. I'm just saying we can compound small, consistent base hits up to 50% net profit, and then trim it, and then let the rest of the process kind of let those tumblers shuffle, right? 600 to 800, that's a 33% profit. 3 times, that's 100%, right? 800 to 1,200, that's a 50% profit. We can do that. 1,200 to 1,500, that's a 25% profit. We can do that. 1,500 to 2,000, that's a 33% profit. We already did it a whole bunch down here. Let's do it again. 2,000 to 2,500, that's a 25% profit. We just did that back here. We can do it. Does that make sense? And I'm not saying it's easy, it's not fast, it's not fun, but it's doable just by looking at the percentages that we need to hit and then making sure that we actually take action up here and trim the account back down, and then take those profits and put them to meaningful use by putting them over into passive income or investments if we're already dealing on the passive income side. So let's say we started with $300 on the speculative side. This money would go over into passive options, right? And then let's say we want to run a Jun, what's your $6 thing? Is that JetBlue? What's your $600 wheel? I can't remember. If you're able to type, I know you guys are driving and stuff. I can't remember off the top of my head. Bull, right? It's Bull, Webull. I just clicked it. I saw the friggin' notepad that I typed out in my brain. Okay, it's 7. He's not driving now. All right. So, okay. So this is cool, right? So let's say that Jun here in this theoretical example starts speculating with $300. That's completely separate from how the wheel behaves on bull. So he's got the wheel over here and he's running the bull, and that's roughly $700 commitment each time he runs a wheel. Now we want to typically double that so we have some cash just in case. So let's say we chop that out into 1,400. All right, maybe, right? We don't have to necessarily. So what's it going to take to get $1,400? Or let's bring this back down to 7. I guess we don't have to make it too complicated. What does it take to get $700 for a second wheel, right? It's going to take 1, 2, 3, 4, 5 trims, right? So we got to go from 300 to 400 3 times. Then we got to go from 400 to 600 2 times. Okay, so 5 trimming events gets us that extra $700 for a second bull wheel. Okay, does that make sense? Until we can afford that, we just stick with the 1. Or just mug someone up. Yeah, those little old ladies, they don't fight back very well. Take their legs out. It's pretty easy. So again, if we only have 300 here and we've only got 700, let's say we did a $1,000 portfolio, for example, and he wanted to do 700 for the wheel, 300 for speculation, and $0 for investment, he could do that. And I'm just using him as an example here. He makes $10 a week on that. That's good. So that $10 a week cascades upward, right? Because you're selling short-term contracts against the shares that you have. The speculation is going to go from 300 to 400, however long that takes. It might take a month. It might take a year. Either way, the small, consistent base hits compound nicely. And what's important mostly is that we bring that extra $100 up into the passive option side so that we can start building towards that second wheel contract, because that's much more reliable. It's a lot safer. It's more consistent. There are still risks, but it's a lot easier to manage. And then once we got 2 wheels going, let's say those are yielding $20 a week because you got 2 of them now, right? That cascades nicely up into the investment side, and then $20 can get you a nice ETF. It can get you a nice cheap ETF, an extra one every week, just pouring in. Now you want to maintain a ratio, obviously, but the potential is there to cascade this stuff up nicely, and it only took us 5 trimming events to get to that point. Oh, I just misdrew that. You only had to trim it 5 times. So we've got a very clear path in front of us now that we can follow, and we know exactly what we need to do, starting from the bottom and scaling things upward and trimming and just shoving the profits up higher and higher into the next level of the hierarchy, all while you're also feeding those same investments with consistent contributions because your budget is stable and you're able to free up a little bit of extra cash here and there on a consistent basis. Plus you've got the dividend yields that are reinvesting as well at a lower frequency, lower rate. That number can get really stupid really quick if you just be efficient about every layer that you're putting into your portfolio. And that's why I want to talk about portfolio structuring today. So if I just erase all this, again, if we just go back to these 4 buckets, right? 1, 2, 3, and then the cash one. Okay. If we've got investments here, passive options here, speculation here, and cash here, if I have settled cash interest, I can put that up into speculation. I can put it up into passive options. I would choose to put it in speculation personally because of the faster return that I'm able to achieve. If I'm not, I would put it into passive options. If I'm not able to achieve a net positive result on passive options, I would just put it directly into the investments and just hold them, right? It's not going to be a lot of money, or I can just leave it in cash and keep compounding that 3.5% yearly, which is going to have a lesser return rate than just if I put it into investments. Now, if I put that cash into speculation and I'm able to grow that faster because of that little bit of added cash, and I'm trimming the speculative amounts every time it hits $400 up to 3 times, I trim $100 out, bring it back down to $300. I put that into passive options. That's an extra $300 that I have now to deal with passive options. I'm almost halfway to my second bull wheel at this point, right? I do that 2 more times from 400 to 600. I trim out $200 each. That's $700. Boom, I just unlocked my second wheel. Until that happens, I'm taking the profits from the first wheel, the $10 a week. Okay? And I'm putting them into investments, or I'm saving up as much as I can into investments. When I unlock that second wheel, that's another $10 a week. Okay? So all along the way, I've got cash earning me cash. I've got speculative profits compounding consistent base hits and trimming those profits into passive options. I'm also trimming the passive options profits into investments, and I'm letting the investments yield dividends and grow and do all the fun things that traditional investors love. Does that process make sense to everybody? And if you don't want to deal with speculation, cut it out of the equation completely. Just go straight to passive options and investments. Not the end of the world. If you can't do it or you don't want to do it, don't do it. If you don't want to do passive options, don't do it. If the data says you can't make a profit doing this, bypass it, right? Just go right around it. You have to follow the data, and you have to let yourself do what you can do without getting in the way. You're not here to have fun, as crappy as it sounds. That's what video games are for. Go play video games. I play video games. I love them. They're fun. They're entertaining. They're a good way to just get away. But at the end of the day, you got to keep your video game separate from your money, and you got to just let the money make money. You can't get in the way of that just because you want to have fun or be entertained. So this is the easiest path to success. Well, I shouldn't say easiest. It's the most direct route, I think. I think is a more accurate way to say that. So again, and the end goal is very clear here. We want to build a massive account full of assets, because those assets are what leverage you out of tax liability and into tax-free debt, so that you can maintain a good quality, wealthy lifestyle without having to pay the government 35% of your profits every year. And you're still going to have, you're still going to have dividends, right? You still have passive options. You still have high churn, which is why we have to, we have dollars turn into shares. Shares shoot out little dollars every now and then. You can then take those dollars and reinvest them into other smaller shares, dividend shares, fellas. And then you can also take those... I drew that wrong. I'm trying to think of the easiest way to draw this. What's the best way? Yeah, okay. You know what? It's this line. That's why. I was trying to figure out why it wasn't the best. Okay. So shares go into, cash goes into shares. Shares increase in value. Share also spits out little dollars, which get used to buy new shares. Okay. And then the original share or some other share can get offset by selling for a loss. You get the free share, no tax burden. That's the completely balanced way to do it. If you're looking for cash, you're going to want to reinvest that cash and just assume that you're going to pay taxes on it. If you make a bunch of money and then you lose a bunch of money all in the same year, guess what happens? You don't have to worry about paying taxes on all that money you made because you already gave it back. You already paid it in advance in the form of a capital loss, as long as it's not a disallowed loss. That's why we have to be careful at the end of the year for wash sales. But does this process make sense to everybody? I'm trying to find ways to make it more visual for you guys, so that you guys don't have to figure it out the hard way. You choose whether or not you have taxes to pay at the end of the year. You choose whether or not you have free shares as well. At the end of the day, that's all it boils down to. Most traders mess themselves up because they're chasing cash. But the goal is not to get as much cash as possible. You want to get more cash so that you can use more resources if you're able to. If you're not able to, you're just giving yourself a big fat tax deduction that has a limit on it, so it's not even that great. So with that said, I have to wrap this up here pretty soon. Does anybody here have any questions about this whole process? Because I just threw a lot of information at you. I know I've covered it a couple times, but this is the core of what we're doing here in Rags to Riches. I don't care if you have $10 to speculate with. You can grow that $10. Or you can lose the $10. but you're not losing $40,000 because you're trying to figure out options. Grow the $10 up. Build it. Challenge yourself. Put the rest of that money over in investments or passive options if you want. That's up to you. But if you can't prove to yourself that you can make money with speculation, you don't have to put all your money in speculation. If you can't do that with passive options, you don't have to put it all in passive options. The investment side, the dividend side is always there, and the cash side is always there. You have a minimum profit that you don't have to pay taxes on as much as the short-term capital gains. You know that passive options and speculation all carry exclusively short-term capital gains. You know that the investment side carries little to no tax burden because you're only paying taxes on the dividends, and you can offset those with small losses throughout the year after you reinvest the dividends into new shares. So if you don't want to do this or this, you don't have to. Please start over from the beginning. I can't speculate, and that's why I only speculate with 2% of my worth. I love that. That's great risk management. Because if you can't grow that 2% and you lose it, that means you would have just as likely lost 50% if you used 50%. So absolutely go as small as you want when you're figuring this stuff out. Now, the pitfall that people fall into is they try to trade short-term expiration contracts, and since they have a little bit of money, that forces them to trade farther out, which destroys the probability of profit on those. So if that's the case and you can't afford quality, just don't trade those. You're just going to hurt yourself by trying to make it. That's me. I think it's everybody. Everybody does that. We try to participate in things that we're just not ready for, and that's how we hurt ourselves. So if I have a SPY setup I'm looking at, and the contract is $360, and I've only got $80, I'm not going to go 5 strikes out of the way to get the $80 contract because it's a garbage contract. I want that $360 one. I just can't afford it. So what do? I let it go. I watch the $360 contract to see how I would have traded it in real time so I can get that practice visually and psychologically. But I'm not going to just allow that want to change my decision and cause me to go several strikes out of the way. I just use what I have, and if I can't afford it, I let it go. I can go drive past a Ferrari dealer and want a Ferrari. But if I buy all the Ferraris, and then I go to the next Ferrari dealer and the next Ferrari dealer, eventually I'm not going to be able to afford something that I want at some point in life. And at that point, you just have to accept that you can't afford it, and it's not worth settling for a Pinto. $35. I would never buy a Ferrari. I think it's such a waste of money. And just liability. Like, you're just stressing out everybody around you for no reason. Lamborghinis, too. It's such a stupid idea. Apologies here to anyone that owns a Ferrari, but I don't see the point. It's purely status. You can bring them to a track and drive them around, and that's it. Well, you're going to cause car accidents just pulling out of a grocery store. So, that's how you know you made it. Okay, that's fair. We'll have fun replacing the clutches every 2 weeks and the insurance. We'll see you back here when you're brokey again. I live in GTSR too. Yeah, I mean, if you want to collect cars, that's different than driving it to the store. You can absolutely do that. But again, it's so much extra liability for no reason. If you tap somebody that is not wealthy, and your fender that costs $26,000 to repair has a little scratchy scratch in it, and you have successfully ruined that person's life. And they're going to drive different knowing that, and you're going to cause accidents just by being present. So I just choose not to do that to other people. It just seems like a huge, it's a dick move, honestly. But before we get into Lambos and all that garbage, does this make sense to everybody? I do have to jump off here in a minute. Does this whole process and decision-making tree make sense? You have cash. You have the investment opportunities. You know that they are long-term buy and hold contract or tickers that are not meant to be sold. They are meant to be accumulated. And then you can use those as collateralized entity for tax-free debt long term. The only reason to consider passive options or speculation in this case is to speed things up. So if you can't speed them up, they will slow you down. This is drag. It's financial drag. You might as well go spend that money on something else that you're going to enjoy. If you are practicing, you don't need a lot of risk. You don't need any risk. You're just getting the shapes and colors part down. That doesn't require any investment. When you're able to demonstrate net profitability with those shapes and colors, then yeah, scale into real risk and have that trimming process in place if you want, so that you can funnel those profits safely and reliably up into the next level, like passive options. And then from passive options up into investments. And you go from $10 a week on a bull wheel to $20 a week on a bull wheel when you've unlocked the permission to trade 2 bull wheels. Otherwise, you're over allocating if you do it early. Just like with the speculative side, if you're on the $300 to $400 level and you're suddenly finding yourself dealing with $900, you've violated your plan. And you can take those $600 out, and that's 6/7 of the way up to your next bull wheel right there. Was that after the gas to catch? It looks a little dry. I think it's flaky. All right, let me. Okay, just catch up on the chat there. Oh yeah. All right. With that said, I'm gonna jump off here. I appreciate you guys all hanging out. I hope that this makes sense. I'm gonna post the recording of this as well. Watch this one specifically as many times as you need to, because this is the engine that drives it all. And then we talk about the specifics of, what goes in the investment bucket, what goes in the passive options bucket, what goes in the speculation bucket. We talk about what to look for in investment stocks, like free cash flow, revenue, all that good stuff. And then for passive options, we're going to look at the contracts as well, the market conditions, all that good stuff, sector rotation. And then on the speculation side, you guys already know my strategy. You guys know that it works for me, but I want to make sure something works for you that makes sense. And 90% of it boils down to just doing what you plan to do when you plan to do it and not letting your losses run down 50%. Okay? And using appropriate position sizes and just not living in denial, because that is what's going to chew you up more than anything. And then there's the cash side. We talk about alternatives. We talk about putting things in CDs, which are lockup entities. That's a cash account at a bank, basically. You give them money, and they return a yield after a lockup period, like a year. They offer you interest payment, basically. But it's inaccessible, so you don't want to do that to money that you might need. The alternative there is a high-yield savings account or bonds that are a little bit more liquid. We talk about treasury bills. All that stuff. We're going to build into all that stuff a little bit more as we go. So I'm reinvigorated here. We're going to make sure you guys are financially freaking amazeballs. So, all right. So real quick, one last round. Does anyone have any other questions before we go? And if not, would you mind just putting a 1 through 10 in the chat, just so I know that this information is valuable and that I put it across in a clear enough way that you guys can actually use it or understand it. 1 through 10, 10 being yes, it makes total sense. 1 being none of it makes sense, I'm very confused or I'm angry. Just so I understand. If it's anything less than a 10, would you mind just putting a little comment in there so that I understand what specifically I can improve? And then I'll take that and I'll factor that into my little algorithm for the next time. Snowflake says 3. Thank you, buddy. Porter's goal is to lead a hostile takeover to acquire 10% of a company so you can rebrand as Porterhouse and his 13 Ds. I don't think that came out the way you wanted it to, buddy, after you were just talking about casting couch. That's a lot of D's, buddy. All right, Sigman says 420. Well, you go blaze it, buddy. Efficient. All right, well, I'll leave you to it then. I'm going to end the recording. I appreciate you all hanging out. I'll upload the video and I'll post the link in the Rags to Riches channel, and then we will see you guys at the wrap-up stream if you're in premium. That's at 3:30 p.m. Eastern, and I'll see you guys there.